Brian here from your Everyday Pro Investor team, back at you for another week here. We're going to be talking about the week coming up here, July 20th, as well as what happened last week. So starting overall with the market, last week we had big news. Moderna came out and they showed that their 45 patients in the phase 1 study that they had of their vaccine for COVID-19 all exhibited antibody levels that were 2 to 4 times greater than somebody that had recovered from COVID, as well as obviously the vaccine appears to be safe. This was big news for the market, sent the market higher, sent Moderna up. I think it closed the week around $94. So that was overall positive news for the market. What I think was really interesting about what happened, kind of even before the vaccine news, but definitely after the vaccine news, was the rotation out of big tech into cyclicals, which we have seen previously, but I think we're seeing it again here. Evan, do you think that rotation can hold up?
Not sure. I mean, the only thing that I could really comment on from last week is from a technical point of view. It does appear that the market's setting up to pull back over the next week or so. That's really the only thing that I was saying. I don't know if it could hold up or not.
Yeah, I'm not sure either. I think these big tech names are really well positioned for the environment we're in. I get wanting to be in cyclicals because we get a vaccine, we should get more back to normal, but how quickly does the unemployment return? Does the consumer spending hold up strong? I'm really not sure, but I do agree with kind of what you were saying about the market there, and that it looks like the market's setting up to potentially pull back, and I think you could see a re-rotation potentially depending on any bad earnings news or bad COVID news next week. I think you could see maybe a rotation back into big cap tech. You know, Microsoft traded down to around 202, Amazon traded down. Netflix pulled back some after their earnings report. Obviously, these are all some of the biggest names in the market, and I think that we have Microsoft reporting next week. It's a big week for earnings, and if they report a bad number, which I don't think they will, but it's more about what's the guidance moving forward. Did they pull ahead 3 years worth of demand, so growth is going to slow for them? Those might be the type of things that send that type of name lower. Bad news on cases or shutdowns is what's going to hurt the cyclicals. And if you get some sort of storm, I think you could see that the overall markets pull back. I mean, we're kind of up at the high end of our trading range right now for the S&P. We closed at around 3220. And we talked about it last week, but you know, you could see that pull all the way back down to around 3,000. That kind of seems to be the trading range right now.
Yeah, I know for our hedge, the hedge trades that I have on at least, I look for the 315, 305 spread, which expires early August.
Yeah, and I know in the everyday portfolio, we had the 315 put on for August 7th. That almost doubled. We sold it, and then the market ripped back higher, so we're back in that put. I think it's a good put to own right now. It's not too far out of the money. It's got a couple weeks on it. At some point, I think in these couple weeks, we're more likely to get a pullback below 315 than we are to move up towards new highs outside this trading range. You know, get back up in that 330 range on the SPY, 3,300 S&P. So, you know, next week we talked about earnings, some big names, Microsoft, Texas Instrument, Tesla reports. So, you know, could be some big moves in the market based on those earnings. Let's move into some individual names, though, Evan. We did have a viewer request some information on Jacobs Engineering and Eagle Materials. So we did a little bit of work on those. Do you want to take one of those two names?
Yeah, I'll start off with Jacobs Engineering. So their focus is areas of construction and engineering that require government spending. So I know we talked about this, but we don't necessarily think we'll get an infrastructure bill before the election. You could see one after, and in the event that you do get one after, that's probably the factor that would send this stock to a new all-time high. But with that being said, you could put on a buy here around 83, and then we'd recommend waiting for a pullback to buy the rest. They do report August 3rd. What are your thoughts on this being more of a long-term investment?
Yeah, I think if you're going to enter this name, it is a long term investment because the catalyst to make this stock go higher, it could be 1, 2, 3 years before you see what needs to transpire, right? Whether it's an infrastructure bill getting passed and then being put into motion, it's going to take a little bit of time. Like I said, there's no way before the election that you're going to see one. Could you see one after the election? Absolutely. I think you will see an infrastructure bill in the next 2 to 3 years, but you got to be patient and willing to hold on to this name in order to reap the rewards. I don't think it's going to be a quick trade. I could be wrong, and if you get that catalyst quick, sure, it could be a quick trade, but this is a cyclical name that is highly based on not just economic expansion, but government spend. And, it's one that you can be in. I wouldn't make it a huge position, honestly, just because of the nature. I don't want to hold something that's going to be potentially flat for 2 to 3 years before I see upside, but it's definitely, it can fit into your portfolio. As a 2 or 3% position, you have to have exposure to names like this in a cyclical way in order to have a nice diversified portfolio. And I think it's a name you can put some money to work in. And like you said, you kind of wait for a pullback here, probably maybe even after earnings. You get a pullback, and you can put the rest of that position on. The other name that was mentioned was Eagle Materials, so I'll talk a little bit about that one. Now, this company, they make materials for building, specifically residential and commercial construction. They also, cement is a segment of theirs, so infrastructure play, as well as they also make materials for the oil and gas industry. Oil and gas industry obviously has been hit hard. I'm sure that segment of their business isn't doing as strong as it should. But on a positive note, the boom in new home builds is unbelievable right now. And COVID is only pushing, these more densely populated areas, people that can afford to get out of them. They're moving out. They want these new homes. There's nothing for sale. House prices are going up. Home builders are having, an unbelievable run right now. And I think it's going to continue. This isn't going to be just a short-term trend. I think you're going to see this continue for at least 6, 12, 18 months, something of that nature. And that directly benefits Eagle Materials and what they do. Another positive for Eagle Materials is they are in the ITV, which is the iShares home builder ETF. So as, let's say, that ETF gets dragged up, even if Eagle Materials isn't performing quite well, they could get dragged up by that ETF, which I believe also includes companies like Lennar, D.R. Horton, Home Depot, Lowe's, Sherwin-Williams, all those different plays on that sector. So, looking at the chart, it's in a really nice, well-defined uptrend, which is a positive. I think that with this cyclical play, with the nature of the home builders market, the stock is going to move towards 90. So I think you can get in this name, and I think you're just going to want to ride it out until you see the trend change in home building, which could be 6 months, could be 12 months, could be 18 months, could be 24, who knows. I think this thing moves towards 90 in the near term, so let's say the next 6 months. Then you're going to have to kind of reassess, and obviously things can change on a dime, but I like it for at least 6 months, I would say, and I like it heading towards 90, and then from there you probably got to reassess at that point.
So you're buy and hold on that, and instead of
Yeah, I think it's a good trading vehicle for 6 to 12 months. I would say is what my take is on it.
And then moving into our last segment of our video here, want to touch base on silver that we mentioned last week. We were looking for a breakout, and it did, but still think there's room for it to run here. Both silver and gold actually still look good. I think they both could move higher. So if you did ride that trade with us and you're still in it, I think you can look for a little bit more room there. Any thoughts on that, Brian?
Yeah, absolutely. I think I like silver still a little bit better than gold, which I mentioned last week. Still that catch-up trade, as well as the demand side from a manufacturing standpoint, industrial standpoint. Silver has real-world applications versus gold is more or less a store of value. So I still like silver a little bit better, but we've taken big positions in both. We've made some money. We've trimmed them. Now they're just, I would say, small to normal size positions that they teeter right on that 2, 3, 4% range in the portfolio. Going to continue to hold those. They're both through calls, and they keep going up in value. We're going to kind of keep holding them towards expiration. We've got some time on those, but both look really good right now. Even if you like to play it through futures, I think you can still play silver through futures. But again, that's not a investing instrument that a lot of home gamers should use, just because of the leverage that's in the futures contracts. But overall, like I said, silver over gold, but I like both of them. I'd own both of them. And then, I guess moving on from that, what am I looking at right now from a sector perspective that looks really good is the XLB. This is Materials Sector ETF S&P. Right now, it's bumping up against the $62 level. It is probably going to pull back here in the short term, I think, but it's over the last 2 years hit this $62 level. This will be the third time now. We talk about it a lot. If you see something get tested 3 times, chances are it's breaking out. You look at the short-term charts, a little bit overbought, so I think you're going to pull back around to 60. But at that point in time, I'm looking to buy calls probably up near that $65 level, so a little bit out of the money. Another way to play it would be to buy the 62s once it pulls back to 60 and sell the 65s against it. I think that would be a good move to create a nice call spread here. Evan, I know we talked about it a little bit back and forth, but buying calls or a call spread versus buying the ETF. You want to talk just maybe a little bit about why we decided to go with calls here over the ETF?
Yeah, so typically this doesn't have that much volume in the options game, but I think for this particular trade that we're looking at, there is, especially the 65 calls, there's quite a few there, so you can get into a little bit better of a price. I know the 62, 65, we looked at the potential there. It should be around a 3-to-1 ratio in terms of return on what the overall spread would cost, which is what we typically look for when we put on a spread. So if you can get them cheap enough, just pick up a couple, whatever suits your portfolio. And to your point about it pulling back, I definitely agree that the chart is indicating a pullback. If you put on the trade right now, I'd consider it pretty risky in the event that the chart is signaling a pullback before it takes off. So that's really my 2 cents on it.
Yeah, and one last point here before we wrap up. Let's say it doesn't pull back, Evan and I are wrong, and it breaks through and breaks out. You miss the trade. You don't have to chase it. This isn't one where you're going to want to go, oh, it broke out and it's at 63 now, I got to get in. I think the upside is relatively limited to about 65. Your calls are probably going to cost too much at that point. And buying the ETF, you're going to put a bunch of money into it for what I would consider a small return. And that's why it's all about timing with this play. And the timing is all right, if it pulls back, chart still looks good. Get to that 60 level, you buy the call spread, and it's all good. So with that being said, though, my dog's walking through the camera. Thanks, Daisy. I think that wraps it up for the week. Evan and I appreciate you guys listening. If you don't already, follow us on Twitter at EverydayProInvestor. Make sure you hit the like button and subscribe to our videos. I'm trying to put out a video once a week now that we're back at it. And if you want to follow along with all the trades we make in real time, go to everydayproinvestor.com, get signed up for our member service. You get real-time text and emails with exactly what trades we're making so you can follow along with us. Now let's go out there. Let's have a good week.